So chapter 1 and 2, we're going to sort of lay the foundation for this course. Now, one of the first things that is talked about in chapter 1 is this definition of persons. Now, when it comes to income tax, everything that we're going to be learning is covered in the Income Tax Act. So the Income Tax Act, or the ITA, are all the income tax rules here in Canada. Now, within the Income Tax Act, there's this definition of person. And what it says is that persons are subject to income tax in Canada. Now, if the specific term is defined in the Income Tax Act, then we have to use that definition. So when you think about the everyday definition of person, you're probably thinking, okay, that's, individuals, people. But in the Income Tax Act, they define persons as individuals, corporations, and trust. So when we talk about the Income Tax Act and the definitions that are contained, if there's a specific definition in the Income Tax Act, we have to use that definition. So going back to this first sentence, persons are subject to income tax in Canada. What is a person? A person is an individual, a corporation, or a trust. Now, this particular course, BFIN 351, we're going to focus on individual income tax. And if you end up taking BFIN 451, that's where you're focused on corporate and trust income tax. Now, very little coverage of trust. The main focus of BFIN 451 will be corporate income tax, but trusts are covered in BFIN 451 as well. So this sort of begs the question, if only individuals, corporations, or trust are subject to income tax here in Canada, what about a partnership? And so a partnership is not part of this definition of person. So a partnership is a way to carry on business in Canada. If a partnership earns income, it is not subject to income tax in Canada. So to answer the question, we would say then that even though a partnership is not subject to income tax, the individual partners will be taxed on their share of the partnership profits. And so this is sort of leading to the fact that income tax is based on law. And so because it's based on law, a partnership itself is not subject to income tax. So if you have a business that's operating as a partnership, the partnership itself is not liable for income tax, but the profits that each of the individual partners share in the partnership, they will be taxed on their share of the partnership profits. So that's sort of the first thing I want to talk about is that when it comes to income tax that we're going to be learning, they're all covered in the Income Tax Act, also abbreviated ITA. Now, when it comes to calculating income tax liability here in Canada, there's a federal component and also a provincial component. So if you've ever filled out an income tax return, you'll see that there's a federal income tax payable and also a provincial income tax payable. Now, the federal income tax payable is the same rates across Canada. So the federal component will be the same rates across Canada. And those federal rates are on the rates table. So let me just sort of bring up the rates table that I was showing you earlier and show you where those federal rates are. This top portion here, information available applicable to individuals, these are the individual rates for 2024 that are the same federally across Canada. So if you're an individual, even if you're not, regardless of which province you're in, the rates that you'll be charged will start at 15%, and then they will increase up to 33% if you have any income over 246,752. So we'll go through a short calculation later on to demonstrate how to calculate the federal income tax, but these are the rates that we refer to when we talk about the federal income tax rates for individuals. These are the same and they apply to individuals across Canada. Now, going back to our handout, when it comes to the provincial rate, those vary from province to province. So for the provincial rates, there's different rates and rules for each province. So that sort of begs the question, well, let's say you move from Toronto to Vancouver partway through the year. Which provincial rate do you apply when you file your income tax return? Does anyone know the answer to that? So let's say you're moving partway through the year from Toronto in Ontario to Vancouver here in BC, and you file your tax return for that year. Does anyone know which provincial tax rates will apply? Any thoughts on that? If you have a thought, you can just type it in the chat or just unmute. The rule is where you reside on December 31st. So where the individual resides on December 31st of that year determines the provincial tax rates that will apply. So even if you've lived in, let's say, Toronto for 11 and a half months of 2024, and then you move to BC on December 15th, because you are residing in BC on December 31st, when you file your tax returns for that year, the BC provincial tax rates will apply. Any questions so far? So most of you have probably completed a tax return, or maybe a family member has. When you complete a tax return, there's sort of two main subtotals that are applicable. One is net income for tax purposes, which is on line 236. And then the other amount that's applicable is taxable income, which is on line 260. Now, when you're calculating your income tax liability, it's based on your taxable income. But in order to get to your taxable income, you have to calculate net income for tax purposes first. So what I want to do then is I want to sort of go through the rules of how to calculate net income for tax purposes. Now, once again, you will be taxed on your taxable income, but when you're calculating your taxable income, the first step is to calculate your net income for tax purposes. Now, to calculate net income for tax purposes, we see this formula here, 3A plus 3B minus 3C minus 3D. Those are all parts of the Income Tax Act. So when we talk about these parts of the Income Tax Act, let's sort of break this down. Let's talk about what is 3A. 3A basically refers to Section 3 of the Income Tax Act and subsection A. So the Income Tax Act is broken down into sections, and within each section, it might be further broken down into subsections. Now, there could be even further breakdowns into paragraphs and subparagraphs, but for this calculation of net income for tax purposes, we're going to be going through this formula, 3A, 3B, 3C, and 3D. They relate to Section 3, subsection A, subsection B, subsection C, subsection D. Now, when you use a tax software to complete your tax returns, it does follow these rules. Even though it doesn't talk about 3A, 3B, 3C, 3D, whenever you use tax software, it has to be programmed to follow these rules as well. So as, let's say, a tax practitioner, even though tax software will do all the calculations for you, if you're preparing tax returns for your client and they're asking you, well, how do we get this net income number? You may have to explain to them how it was calculated. And once again, this is different from net income that you learned from your accounting classes. That's one thing that we have to be aware of, is that even though it does refer to net income, this is net income for tax purposes, which is different from how you calculated net income for accounting purposes. Now, this net income calculation is summarized in figure 1-5 in your textbook. So 3A, 3B, 3C, 3D. So what I want to do is actually just sort of put some numbers to a simple calculation. So let's say we're looking at an individual for the year 2024. And for the year 2024, we want to calculate their net income for tax purposes. So we start off with 3A. 3A is positive amounts of employment, business, and property income. Now, what I've also done is put chapter references for where we're going to explore these amounts in further detail. So when we get to chapter 3, we're going to look at all the rules that relate to calculating employment income. When we get to chapter 7, if you're self-employed, if you have a sole proprietorship, then the rules for calculating business income will be covered in chapter 6. Rules for calculating property income will be covered in chapter 7. Now, employment income is pretty straightforward. You work for a company, you're an employee, you earn employment income. Business income, pretty straightforward. You operate a sole proprietorship, then you report the business income as your own. But what is property income? Examples of property income would include things such as dividend income, maybe interest income, rents, and royalty. So when it comes to property income, that is usually passive in nature. So you invest money in a term deposit, you earn interest income, you buy a rental property, you rent it out, you don't have to do a lot of work. That is considered property income. So there's different rules for how you calculate these different types of income. Now, included in 3A as well is also pension income. So if you collect CPP or OAS, or maybe a company pension plan, or maybe you withdraw some money from your RRSP, that would be included as pension income. And you would include that in 3A if you receive those types of income in 2024. Also, if you received any spousal support, let's say you were involved in a separation, and in part of that separation agreement, you were the recipient of spousal support every month, you would have to include that in your net income for tax purposes calculation as well. So once again, we're going to be exploring these individual amounts in more detail, but let's say for argument's sake, this individual has net employment income for the year of $20,000. So we're going to say that this individual has net employment income $20,000. So $20,000 would be added to their net income for tax purposes. Then we move to 3B. 3B is the excess, if any, of any taxable capital gains over allowable capital losses. So when it comes to 3B, we're looking at the sale of capital assets. And if you remember from your accounting classes, you probably heard the term capital assets before. Capital assets are basically assets that were purchased to sort of generate income. So this sort of, for individuals, mostly relate to the sale of shares. So let's say you buy some shares, you're hoping to generate some dividend income for those shares to pay dividend. If you eventually sell those shares, then you may have a capital gain if you made money, or a capital loss if you lost money. So let's look at this individual. Let's say this individual during the year sold some Bell Canada shares and also sold some TELUS shares. What we need to do is figure out whether they have a capital gain or capital loss. We start off with the first row, proceeds of disposition. Proceeds of disposition is what they sold the shares for. So let's say they sold the Bell Canada shares for $1,000. In calculating whether there's a gain or loss, we minus any commissions. So let's say they were using a trading platform where they were charged a $50 commission, we minus that as well. And then we minus what's called their adjusted cost base. How much did they pay when they bought those shares? Let's say they bought these Bell Canada shares for $700. And so we can quickly calculate whether they have a gain or loss. And in this example, they have a gain of $250. Now, this $250 is known as their capital gain. And if you have been following sort of how capital gains and capital losses are taxed here in Canada, you'll know that capital gains and capital losses are taxed at 50%. So the capital gain is $250, but the taxable capital gain is 50% of that, which will be $125. So terminology is important. When you are referring to the capital gain, you're referring to the 100% amount. When you're referring to the taxable capital gain, you're referring to the 50% amount, and that's what you include in 3B is the taxable capital gain. Let's continue on and say that this individual also sold some TELUS shares. And they sold the TELUS shares for $500. That's the proceeds of disposition. Let's say they were also charged a $50 commission. And let's say their adjusted cost base, what they bought the shares for. And once again, I'm just using sort of an extreme example here. Let's say they lost a lot of money. Let's say they bought those TELUS shares for $19,500. So once again, just using an extreme example to illustrate the calculation here. So in this example, on the sale of the TELUS shares, this individual would have lost $19,050. This is known as the capital loss. Once again, only 50% of that is allowed. So the allowable capital loss is going to be $9,525. This is known as the allowable capital loss. And once again, it's only the 50% amount, the allowable capital loss, that we use. Any questions so far about these calculations? Now, the one thing about income tax is that the wording we have to pay careful attention to. 3B says excess, if any, of the taxable capital gains over the allowable capital loss. So what this means is that 3B can only be a positive amount, or nil, it cannot be negative. Arnold, did you have a question? You can feel free to unmute.
Yes, Professor, I had a question. When you say by allowable capital loss, do you mean what about the remainder of the 50% that is left from the loss? Is that the one that is taxable?
No,
Just
so the other 50% you cannot claim.
okay.
So just like with the capital gain, you're only going to be taxed on 50%. So you only have to include 125, not 250. With losses, you can't claim the whole 19,050. You can only claim 50%.
Okay,
So
thank you, Professor. I see.
yeah, so only 125 will be taxed, and only 9,525 will be allowed to claim as a loss. The other 50% is not allowed. So when we look at this definition of 3B, it says the excess, if any, of the taxable capital gains over the allowable capital losses. What this means is that 3B must either be positive or nil. What that means is we cannot have a negative number. But if we add up these two amounts, the 125 plus the negative 9,525, we have negative 9,400. And so, Olivia, you're right about carrying the capital loss. We'll talk about that in a second. So if we go back to the wording of 3B, because we have a negative amount, that means 3B for this year is going to be 0 because we cannot have a negative amount. We are allowed 9,525 of the loss. We have a taxable capital gain of 125. So we can offset the taxable capital gain with the loss, but we still have this amount that is unused. Because the 9,400 cannot be used this year, remember 3B must be positive or nil, this 9,400 loss will carry over. What that means is we don't lose it, we just can't use it this year. Now, because this is a result of capital gains and capital losses, this 9,400 is known as a net capital loss carryover. We cannot use it this year, but we can use it in other years. And so with loss carryovers, there are certain rules. A net capital loss carryover can be carried back up to 3 years, and it can be carried forward indefinitely. But the thing about this 9,400 loss, it can only be used to offset taxable capital gains. So let's say last year, we had a taxable capital gain. We could carry it back to offset some of the taxable capital gains from last year. But what we're going to do in this example, we're going to do a 2-year example. So we're working on 2024 now, and then we're going to move into 2025. And what I will show you later is how we can use this loss in another year. But 9,400 of the loss we cannot use this year. So 3B will be 0, but we don't lose that loss. It becomes what's called a loss carryover. We can use it in other taxation years. So where are we at now? 3A is 20,000. 3B is 0. So we basically have 20,000 moving into 3C. So let me just sort of put down here. So subtotal of 3A plus 3B is equal to $20,000. And so we have to work through these sequentially. Start off with 3A and then 3B, and then we move into 3C. So 3C are deductions. They're known as subdivision E deductions. We're going to be learning about them in chapters 9 and 10. Moving expenses, childcare costs, spousal support paid, RRSP deduction. So you probably heard of RRSP. The government wants to encourage you to save for retirement. So they say that while you're working, you can put money into an RRSP. You get a deduction in the year that you put the money into an RRSP. And so that's basically encouraging individuals to save for retirement. So let's say this individual put $5,000 into an RRSP. They will get a $5,000 deduction when they're calculating their net income for tax purposes. So the subtotal now, after 3C, will be $15,000. The subtotal before 3C was 20,000. They put 5,000 into an RSP. That's going to reduce their net income by 5,000. So the subtotal now is 15,000. Now, RRSPs are known as tax deferral. What that means is when you put money into an RSP, you get the deduction this year. So it reduces your tax. But the reason it's known as tax deferral is that when you retire and you take the money out of your RSP, you have to include it in 3A. So this year you're working, you put money into an RSP, you get the deduction this year, so you have less income, you pay less tax. 30 years from now, when you retire, you start taking money out of your RSP, you have to include it in income, you're taxed on it, but it's deferred until much later on. So because of time value of money, it really benefits Canadians to put money into the RSP because they get a deduction now, and they won't get taxed on it until likely later when they take the money out. Any questions through 3C? So now let's go to 3D. 3D is losses from employment, business, and property. Remember 3A, we only included positive amounts. So what if you lose money in your sole proprietorship? What if you lose money on your rental property? Well, the losses will be deducted in 3D. And so once again, even though on an actual tax return, you don't see this 3A, 3B, 3C, 3D, when it comes to tax software, all these rules are sort of built in to the tax software. So what about 3D? Let's say that this individual operates a sole proprietorship, and their sole proprietorship for the year had a loss of 20,000. So the subtotal going into 3D was 15,000. They operate a sole proprietorship. This year they had a loss of 20,000. So that's going to bring down their net income for tax purposes. Now, net income for tax purposes, as I've listed down here, must be positive or 0. It cannot be negative. So if we have a subtotal of 15,000 and they have a business loss of 20,000, the net income for tax purposes is going to be 0. But some of this business loss is unused. 5,000 of the business loss is unused. Because remember, they only used 15,000 to bring their income down to zero. You cannot have a negative net income for tax purposes. So similar to the loss we had in 3B, this loss will be carried forward. This 5,000 is known as a non-capital loss carry forward. Or carryover of 5,000. Now, terminology is really important. Remember that loss that we did not use in 3B? That was a net capital loss because it resulted from capital gains and capital loss. This loss was a result of a business loss, so it's non-capital in nature, a non-capital loss. Now, the rules are kind of similar, but they're a little bit different as well. Non-capital losses, we can always carry back 3 years, but we can only carry forward 20 years. Now, when it comes to non-capital losses, they can be used to offset any type of income. So a little bit different from the net capital loss. Let's just sort of analyze these two types of losses here. The 9,400 is a loss that results from 3B from the sale of capital assets. That's known as a net capital loss carryover. We can carry it back 3 years, we can carry it forward indefinitely, but it can only be used to offset taxable capital gains because it originated from allowable capital losses. With the business loss, it's non-capital in nature. We can carry it back 3 years, carry forward only 20 years. After 20 years, we will lose the amount if we haven't used it, but we can use it to offset any type of income. So it's likely that we'll be able to use the 5,000 because we can use it to offset any type of income. So it's very likely that over the next 20 years, we'll likely be able to use it. So this individual for 2024 will have zero net income for tax purposes. And because their net income is zero, their taxable income will be zero as well. And what we'll see is when we get to chapter 4, well, actually in the next example, we'll talk about any differences between net income and taxable income. But in this simple example, this individual's net income and taxable income are both zero. It cannot be negative. It must be positive or nil. Now, even though this individual does not have any tax liability because their income is zero, I always tell students, always file your tax returns, even if you're losing money. And the reason for that is that you want to establish these losses. If you lost money doing some stock trading, if you operate a sole proprietorship and you lost money, you want to file the tax returns for those years to record all those losses because those losses can be used in other years. So this is 2024. Let's then summarize where we're at with the net capital loss and non-capital loss going into 2025. So the net capital loss was 9,400 and the non-capital loss was 5,000. So let's move into 2025. So once again, just a simple example to illustrate how to calculate net income for tax purposes. So in 2025, let's say that this individual had net income, net employment income of 10,000. And let's say that this year their business, their sole proprietorship was a lot more successful. So they generated 40,000 in business income. So the 3A total is going to be 50,000. Then we move to 3B. Let's say this year they sold some Royal Bank of Canada shares. The proceeds, what they sold the shares for, was 10,000. They were charged a $50 commission. And let's say that they bought their RBC shares for only $950. And so their capital gain was $9,000. Now, once again, this is their capital gain. Only 50% of that is going to be taxable. So their taxable capital gain is going to be 4,500. So we have 3A, 50,000, 3B, 4,500. Let's assume that this year 3C and 3D are 0. So the net income for tax purposes is going to be 54,500. And once again, this is on your tax return. This is that line 236. So this is line 236 on the tax return. So if you have filed an income tax return, maybe after today's class, have a look at last year's tax return, or maybe you have a family member that has filed a tax return. If you look on line 23600, you'll see that that is the net income for tax purposes. Now, net income for tax purposes is based on current year amounts. So net income for tax purposes is taking all your income and losses for the current year and doing this calculation. Once again, net income for tax purposes must be positive or nil. It cannot be negative. Now, what happens when we calculate taxable income? Well, to get from net income to taxable income, we sort of go through that in chapter 4. But part of the deductions that we can make to go from net income to taxable income is using some of those net and non-capital loss carryovers. So remember the net and non-capital loss carryovers that they had at the beginning of the year? We can now use them if we have the right type of income to reduce our taxable income for the current year. Remember this net capital loss carryover? We said that the net capital loss carryovers can only be used to reduce taxable capital gains. So how much can we use in 2025? Well, our taxable capital gain was 4,500. So we can use 4,500 of the net capital loss, and the non-capital loss, we can use all of it because the non-capital loss we can use against any income. So those losses will help us reduce our taxable income for the year to $45,000. Now, going forward, the net capital loss, we started off with 9,400. We use 4,500. We will still have 4,900 remaining. But for the non-capital loss, we used all 5,000. So we have 0 remaining. So this sort of simple example sort of illustrates the rules 3A, 3B, 3C, 3D of how to calculate net income for tax purposes. But it also sort of shows how these loss carryovers, these losses that we can't use in a particular year, can be carried over to other years to reduce the income for other years. Now, the taxable income, once again, if you want to look at a tax return, that's going to be line 260 on an income tax return. So if you're sort of curious, grab your tax return or grab a family member's tax return, look at line 236, that's the net income amount. Line 260 is your taxable income amount. Any questions about this example? So what I want to do is I want to actually reinforce what we just learned by going through assignment problem 1-12, which is on page 62 of your textbook. And what I've done with these handouts is I've sort of cut and paste the questions here, so that way you have access to the question during the Zoom lecture. So let's look at case A. We have 2 different cases for this individual, Christina, and basically we want to calculate her net income for tax purposes. For case A, she has employment income from a business that she carries on as a sole proprietorship. She also has a rental property which lost money. She also disposed of a bunch of capital assets, and they've calculated the taxable capital gains and allowable capital losses for us. Now, this is important. When you're reading these questions, we're given the taxable capital gain and allowable capital losses. These are already the 50% amounts. So we don't have to multiply them again by 50%. This is a common mistake made by students in this course. They'll read a question, they'll forget that taxable capital gain means that 50% has already been applied, and they'll multiply it by an additional 50%. If the amounts given were capital gains and capital losses, then yes, we would have to multiply by 50%, but the amounts we're given are the taxable capital gains and allowable capital losses. We're also told that she has spousal support that she paid. Remember, that's a 3C deduction. And then we're told that she went to Las Vegas and she won a bunch of money playing roulette. Now, does anyone know whether or not winnings from gambling are taxable here in Canada or not? Anyone know the answer to that? If you do, just maybe shout it out or put the answer in the chat. Are winnings from, let's say, lotteries or gambling taxable in Canada?
Not in Canada.
Not in Canada. You're right, Max. So in Canada, winnings from lotteries, from casinos are not taxable. The only exception to that is if you are a professional gambler. So if you ever watched Poker Stars, those individuals are professional gamblers. That is their profession. They're doing that as their occupation. And so that would be taxable to those professional gamblers. But in this example, Christina is not a professional gambler. She went to Las Vegas. She just happened to win 123,000. That is not taxable in Canada. However, it is taxable in the US. So we're not going to talk about US tax, but in the US, if she won at this casino, the casino will probably withhold some US tax before giving her the difference. But for Canadian purposes, that amount is not taxable. So we don't have to worry about that. So in this question, we want to figure out what is her net income. So even though it just says net income here, we're basically referring to her net income for tax purposes. And we also have to indicate whether there's any loss carryovers for the current year. So let's just sort of go through case A together. And so once again, follow along on your handout. So remember 3A is positive amounts of employment, business, and property income. So in the question for case A, there was employment income, there was business income. And so those are the two amounts for 3A. For 3B, we have the taxable capital gain and we have the allowable capital loss that were given to us. Now, when it comes to the 3A subtotal, it'll just be 59,700. When it comes to 3B, we know that 3B cannot be negative. So what do we have when we add up these two amounts? We're going to get a negative amount. So we know that 3B will equal 0 because we cannot have a negative amount. But this 9,140, this unused amount becomes what we call a net capital loss carryover. Net capital loss carryovers, we can carry back 3 years. We can carry forward indefinitely. And we can use it to offset only taxable capital gains. Just like we saw in the previous example. So the 3A amount, 59,700, 3B is 0. And then we have those 3C deductions. If you remember from above, the 3C deductions, those were childcare costs, moving expenses, spousal support paid, RRSP deduction. In this example, she paid spousal support, 4,800. And then we're also told that she has a rental loss of 2,350. So that would be in 3D, a rental loss of 2,350. Let me just double check those amounts. Yeah, spousal support paid, rental loss. So now we can calculate her net income for tax purposes. It'll just be the 3A amount. 3B is 0 minus the 3C minus 3D. And so her net income for tax purposes is going to be 52,550. And the loss carryover that she has is a net capital loss carryover of 9,140. Any questions about case A? So have a look at case B. Just take maybe about a minute, see if you can come up with the answer for case B. So I'm just going to set the timer to a minute. Take a minute, see if you can come up with the answer for case B, and then we'll take it up together as a class. So case B, she has employment income, interest income, rental income. Now she's also part of a partnership. And remember we said earlier on that partnerships are not in the definition of persons. So the partnership itself will not have to file a tax return, but Christina will share in the losses and profits. Now the partnership had a loss of 144,940, and so Christina will get 60% of that business loss. That business loss will go into 3D. She also has some taxable capital gains, some allowable capital losses, and she also made a contribution to her RRSP. So let's go through case B together and see if you came up with the same answer that I am going to do. So we start off with all the income that she had. So the 64,000, the 2,600, and the 4,560. And so the 3A subtotal is going to be 71,160 for 3B. Once again, the excess of the taxable capital gains over the allowable capital losses. And so for this example, we actually have a positive amount. So 3B will be 3,045. We do sort of a quick subtotal. So let's just do a quick subtotal here. Oops. So 3A plus 3B, do a quick subtotal, we get 74,205. And then we can minus the RRSP amount. And so she contributed 12,480. And so once again, do a quick subtotal. So going into 3D, we have 61,725 as the subtotal. Then we get to the 3D partnership loss. So her share, and once again, let me just sort of double check the amount. She has a 60% share. Of the 144,940 loss. So 60% of that is going to give her a loss of 86,964. Let me just double check that calculation. Yeah. And so if you're asked the question, what is her net income for tax purposes? Then the answer would be 0, because you cannot have negative net income for tax purposes. But we do have some amount of this loss that is unused. So what is the amount that's unused? It is 25,239. So this 25,239, because it is a result of a 3D loss, this is known as a non-capital loss carryover. And we can carry this back 3 years. We can carry it forward only 20 years, but it can be used to offset any type of income. And so that's sort of one of the main things that's talked about in chapter 1 is how to calculate net income for tax purposes. And those totals, once again, sort of mirror what we would see on an actual income tax return. Any questions about case B? So question about, is the employment income have deducted tax? So when we talk about this employment income, I think it was 64,000, right? Let me just take a look here. Where's the question? Oh, hold on a second. Oh, yeah, employment income 64,000. So in case B, the employment income of 64,000, that is the gross employment income. So the 64,000, that is your gross employment income. Now, obviously, you know that you get income taxes taken off your paycheck before you get paid the net amount. But the income tax that's taken off will basically is like a prepayment of taxes. Once you figure out how much tax you owe for the year, you minus the income tax that has already been deducted from your paycheck, and then you basically just pay the difference, or you get a refund if you overpaid. So this 64,000 is the gross amount before taxes are taken off. But you do get a credit amount later on for all the taxes that you've paid during the year. And I'll sort of show you a short example of that a little bit later on. So in this case, if her net income is 0, that means she will not have to pay any taxes. And if she did get taxes taken off her paycheck, then yes, she will get a refund. And once again, we'll sort of go through sort of a simple example in a few minutes. What I want to do next then is talk about how to calculate your federal income tax liability using those rates table. So remember that rates table that I showed you at the very beginning of those federal income tax rates? So you're going to be calculating your federal and provincial tax liability based on your taxable income, not your net income. Remember, there's a difference. But let's say that we've done the calculation for taxable income and it's 150,000. So I'm going to be referencing this rates table. Let me just bring it up again. Hold on. I'm going to be making reference to this rates table in the calculations that I do. So make sure that you have access to this rates table. It is available on eLearn. So make sure that you've downloaded this and have this open as well. And what you'll see is that there are these different tax rates, 15%, 20.5, 26, 29, 33. These are known as marginal tax rates. So what that means is that when you are calculating your income tax liability, if you sort of look at the rates table, the way that that rates table works is that on the first 55,867, you're only going to be paying federal tax at 15%. So if you look at the rates table, you'll see that there's the amount 55,867. On the first 55,867, you're only going to be charged a federal tax rate of 15%. So if you work through the math, 55,867 times 15%, you're going to get rounded 8,380. On the amount between 55,867 and 111,733, once again, this is all on your rates table, you're going to be paying 20.5%. So on the amount between those two numbers, you're going to be paying federal tax at a rate of 20.5%. Now, if you work through the calculation, let's just sort of do this together. The tax will be 11,453. Now, what you're probably sort of noticing is that, well, that 8,380, that's sort of in that middle column there. And then if you add up these two numbers, whoops, hold on. You add up these two numbers, we get 19,833. That's that number in the middle column as well. So I'll sort of explain that to you in a second. This is what we know as marginal or progressive rates. Marginal or progressive rates is what we have here in Canada. What that means is that the more income you make, the higher your tax rate will be. But on the first 55,867, everyone will only pay 15% federally. Now, keep in mind there's provincial tax as well. We're just looking at the federal tax. Now, this individual has 150,000, so we still have to calculate even more. On the remaining amount, over the 111,733, we go to the next tax rate, which is 26%. And that's going to give us 9,949. So we just sort of quickly add up these three amounts here. The total federal tax on 150,000 is 29,782. Now, I just sort of make a note. There is provincial tax as well. Now, because the provincial rates vary from province to province, in this particular course, unless told otherwise, we're just going to focus on the calculation of the federal amounts, but keep in mind that there are provincial amounts as well. So what often you hear individuals say is that this individual has a taxable income of 150,000. You might hear them say, oh, I'm in the 26% federal tax bracket. That doesn't mean they pay 26% on every dollar, but on the top amount they earn, they do pay 26%. But once again, on the first 55,867, they pay 15%. On the amount between these two numbers, 20.5, and it's only on the amount over 111,733 that they pay 26%. This is known as marginal or progressive tax rates. So how can we use sort of this rates table sort of more efficiently? So in order to use sort of this rates table efficiently, if we know that we have taxable income of 150, we kind of figure out which row we're in. The first column says taxable income in excess of. Well, it's more than zero. It's more than 55,867. It's more than 111,733, but it's not more than 173,205. So to sort of use this table efficiently, we know that the row that we're going to be in is the one where it says taxable income in excess of 111,733. Because we know that we're in that row, what we can do then is take that amount in the middle, that 19,833. That is the tax on the first 111,733. And then to that, we can just add the amount that we pay on the amount over 111,733. And if we work through this calculation, we would get 19,833 plus 9,949, and that would give us the same total, 29,782. Now, obviously, if you're using accounting software, this calculation will be done for you. But the reason I sort of did this was to sort of show you that what we mean by marginal or progressive rates, even though you're paying 26% federally on the top amount that you're earning, you are paying 15% on the first 55,867, and then 20.5% on that amount in between as well. So for the provincial tax rate, just looking at the question in the chat, Sam, the provincial calculation also uses the taxable income amount. So you calculate your taxable income. That taxable income will be used to calculate your federal tax and also your provincial tax. But the provincial tax rates and the income brackets vary from province to province. So yes, there will be progressive rates as well, but the income ranges will be different from province to province. Hopefully that answers your question. If not, just let me know in the chat, Sam. So I just wanted to show you that quick calculation before we move into the next part. Let's talk about a little bit in chapter 2.
So did you say you're gonna take the amount in between in the tax bracket?
So for, are you talking about this calculation that I did here, Arnold, or about
Yes,
provincial?
correct.
Sorry, I missed what you said.
Yeah, on the calculation of the last calculation over there.
Okay, so this 19,833 here, that's the tax on the first 111,733. And the amount over 111,733 will be at the 26%. So it will only be on that portion that will be taxed at 26%. The rest will be taxed at either 15% or 20.5%.
Thank you.
Does that answer your question?
Yep.
Perfect. Okay, any other questions before we move on? So once again, this particular course is focusing on individuals. Well, we will do a little bit about corporations in chapter 2, but the majority of the course will focus on individuals. Individuals file what's called a T1 return, and that is due on April 30th of the following year. The only exception is if the taxpayer, and I abbreviate taxpayer using TP, if the taxpayer or their spouse is self-employed, the filing deadline is extended to June 15th of the following year. And then I put down here, however, the final payment of tax is due by April 30th. So what do I mean by that? Let's look at this simple example here. Let's say we have this individual, Joan. Joan has both employment income and business income. And let's just assume that her taxable income for the year is 175,000. Now, we're not going to calculate the provincial tax liability in detail. So let's just say, for argument's sake, that based on this taxable income, her total federal and provincial income tax liability owing is 60,000. What we're going to see in chapter 4 is that individuals are eligible for what we call non-refundable tax credits, and that can reduce the amount of tax that you owe to the government. So based on 175,000, her total federal and provincial tax owing is 60,000. But because of these non-refundable tax credits that we'll learn about in chapter 4, that will be reduced by 10,000. So she only owes 50,000. Now this kind of relates to the question that Olivia was asking earlier. We include her gross employment income when we calculate net income and taxable income. But all the tax that her employer withheld, she'll get credit for. So even though she owes 50,000 based on all her gross employment income, all her business income, minus the tax credits, she's going to get credit for the 20,000 that was taken off her paycheck by her employer. Now, some individuals are required to pay installments as well. If you're self-employed, no one's taking taxes off during the year for your self-employment income. So some individuals, mostly those that are self-employed, have to make installments during the year as well. So let's say Joan also paid installments during the year of 25,000. So she's going to get credit for this 45,000 of taxes. Some of it was withheld by her employer before she was paid. Some of it she paid during the year because she's self-employed. And so she's going to get credit for that 45,000. So she will only end up owing $5,000 when she files her tax return. Now, there's a difference between when the tax return needs to be filed by and when the final payment of tax needs to be paid. Because she's self-employed, the filing due date will be June 15th of the following year. However, this 5,000 payment of tax needs to be paid by April 30th of the following year. So because she's self-employed, her filing deadline gets extended to June 15th, but any taxes owing, she needs to pay by April 30th. So you're probably thinking, well, how do we do that if we don't file the tax return? So what usually happens is, if we have an individual that's self-employed, but they haven't yet completed their tax return for the year, we will tell them to make a payment by April 30th, estimating how much additional tax they think they will owe. So that way it will stop any interest and penalty if they did not make the payment on April 30th. So usually it's just going to be an estimate. But the best scenario is that if you are self-employed, even though you're given till June 15th to file your tax return, file it by April 30th regardless. That way, if you owe any additional taxes, you'll be able to pay the right amount by April 30th. So the tax liability, the 60,000, that's the calculation based on this 175,000 of taxable income. So that's sort of this calculation that we did up here. Now this is based on 150, but the tax liability is basically this calculation that we did up here for 150. That's the amount of tax based on the amount of taxable income. And then that can be further reduced by these non-refundable tax credits that we'll talk about in chapter 4. And then the resulting amount is how much they owe for the year. The amount they owe for the year will then be reduced by the amount they paid during the year. Some of it was withheld by their employer. Some of it they paid as installments during the year. We'll talk about installments in a second. And then the amount that they will end up owing by April 30th is the 5,000. Now, what happens is, if they don't pay the 5,000 by April 30th, then they will be charged interest and penalties until they make the payment. Now, when it comes to installments, we'll talk a little bit about installments after the break, but if all you do is work as an employee, likely you do not have to make installments because all the taxes are taken off every paycheck. So if you get taxes taken off, you work for one company, they take off the right amount of tax every paycheck based on your projected earnings for the year, you don't have to make installments. But if you're self-employed, you don't have to, no one takes off any taxes before they pay you. Your customers don't take off any taxes before they pay you. So the government says, well, if you're self-employed, in order to make things fair for those that are working as employee and get taxes taken off every paycheck, if you're self-employed, then you need to make installments during the year. And those installments will be made on a quarterly basis, March 15th, June 15th, September 15th, and December 15th. And we'll talk about installments in a second, but that's sort of the rationale behind why you have to make installments, because no one's paying any taxes for you on all the self-employment income that you're earning during the year. So in order to make things fair, you have to make installments during the year based on a formula that the CRA provides you. So we'll sort of talk about that after the break, but that's sort of the next topic we're going to talk about, when individuals are required to make installments. But let's just sort of talk about this rule before we take a break. Individuals are required to make installments if the net tax owing is greater than 3,000 in the current year and either of the prior 2 years. So this is important because this is an and statement. An and statement means both have to be true in order for installments to be made. So what is net tax owing? Net tax owing is the total federal and provincial tax owing for the year minus all the tax withheld at source, meaning all the tax that the employer withheld. So we use Joan's example as well above. The total tax that she owes for the year, and once again, the terms might be a little bit off, but we're looking at that 60,000. The total tax she's owing is 60,000 for the year. And the tax that was withheld by her employer at source was 20,000. So her net tax owing for the year is 40,000. Now we don't have any of the prior year's information, but that's how we sort of calculate net tax owing. They look at your total federal and provincial income tax liability for the year, minus how much was taken off by your employer. And if there's an amount greater than 3,000 for the current year and either of the prior 2 years, then you need to pay installments for the current year. Thing about the current year is that the current year will always be an estimate because the installments need to be made for the current year on March 15th, June 15th, September 15th, and December 15th. So because you need to determine whether you need to make installments at the beginning of the year, all the current year calculations will just be estimates. And so we'll sort of go through that in this next example here, but we'll take a break before we jump into this example looking at installments. Any questions before we take a break? So what we're going to do now then is we're going to go through assignment problem 2-3, and this is going to focus on determining whether or not this individual needs to make quarterly installments for the 2024 year. And as you sort of mentioned before the break was that we need to sort of follow that rule. Is the net tax owing for the current year greater than 3,000 and either of the prior 2 years? And so how do we calculate net tax owing? The way we calculate net tax owing is we take the total federal and provincial tax for that owing for the year minus all the taxes withheld at source by their employer. So this question, we have 3 cases. We're going to focus on case 1 first. Oops, hold on. So case 1, this is the, oh, hold on here. What we have here at the top, let me just get here. This is the amount that was withheld by his employer. So the amounts withheld by his employer, those are the same for all 3 cases. What is different is the total income tax payable for each of the years. And we're going to focus on case 1. So keep these totals or these numbers handy. So we're just going to scroll back here and look at case 1. So the net tax owing for 2024, once again, this is just an estimate. We take the taxes estimated to be owing for the year, 14,327, minus the tax withheld at source, 10,476, and that's going to give us 3,851. So that would be the net tax owing for the current year. Once again, this is just an estimate because we're at the beginning of 2024. Now for 2023, if we do the calculation, we're going to get 3,190. And so once again, for 2023, if we scroll back here, for case number 1, that's going to be the 12,862 minus 9,672, 3,190. Now this concept of net tax owing basically says, is there any positive amount? If we look at 2022, we take 7,843 minus 8,946. So for 2022, they actually get a negative amount. So there's actually no net tax owing for 2022. So for 2022, the amount would be 0 because we have a negative amount. Now remember, the rule says the net tax owing for the current year must be greater than 3,000 and either of the previous 2 years, one of them also has to be greater than 3,000. Because this is an and statement, it means that both have to be true. Is the net tax owing for the current year greater than 3,000? Yes. And is either of the previous 2 years net tax owing greater than 3,000? Yes, one of them is. So as long as one of them is, this statement is true. Because this statement is true, what that means is that this individual will need to make quarterly installments for the year 2024. Those quarterly installments will be due on March 15th, June 15th, September 15th, and December 15th for the current year, for 2024. Then the question is, well, what amounts will they have to pay? And this is sort of where we get into these three alternatives. When you read the textbook, you'll see that the 2024 installments may be made using any of the following three alternatives. Now, the one that the CRA will use is this last one here. The CRA will also send the taxpayer quarterly installment notices saying that you need to make installments for the current year, and these are the amounts that we've calculated. Now, as a taxpayer, you can use any of these three methods to determine your installments. But the only caution about using the current year is that this is just an estimate. So if you underestimate the amount that you have to pay, then you may be charged penalty and interest. So if you use the current year calculation to determine your quarterly installments, because it is an estimate, if you happen to underestimate the amount of taxes you owe to base your quarterly installments on, then you may be charged penalty and interest. But let's just sort of go through these calculations together. The way we calculate the quarterly installments under the current year method is we take the current year net tax owing. Once again, that was 3,851. And we just divide that by 4 because there's 4 quarterly installments. So that would be 962.75 per quarterly installment. So if this taxpayer decided to use the current year method, if they were pretty sure that that would be the amount of tax they would owe for the year, they could just divide that by 4, pay 962.75 on these 4 dates. Another method they can use is called the preceding year method. They will look at last year's net tax owing. Last year's net tax owing was 3,190 divided by 4. We get 797.50 per quarterly installment. Now that number is going to be pretty accurate because it's based on your actual tax return that you filed for 2023. So that might be a good option to use because that's based on a confirmed amount. But let's talk about the method that the CRA uses. The CRA uses this method called the second and first preceding year. And what they do is for the first and second installment, remember there's 4 installments, they go back 2 years. So they, in this example, they would go to 2022. And the 2022 net tax owing was 0. Remember, it was a negative number. So what we'll see in the next case is that we won't have 0, but whatever that number is, we divide it by 4. And that would be the amount of the first and second installment. So using the CRA method, because there was no net tax owing 2 years ago, the first and second installment would be 0. For the third and fourth installment, they would go back to last year's 2023 net tax owing was 3,190. And what we're going to do with that total is we're going to minus the amount that was paid in the first and second installment. Now, how much was paid in the first and second installment? That was 0. So then what we have is 3,190 divided by the remaining 2 installments. because there's only the third and fourth installment left. And so they would end up paying for the third and fourth installment, $1,595 for the third and fourth installment. Now, I want to just talk a little bit about why the CRA uses this method. If you think about the first and second installment, oh, hold on a second. The first and second installment is going to be due for 2024 on March 15th and June 15th, 2024. Now, if we think about when the 2023 T1 will be filed. So the 2023 T1, if this individual is self-employed, is going to be filed by June 15th, 2024. If this individual is self-employed. Remember we said it could extend it to June 15th. So the CRA does not yet have last year's information when they calculate these first two installments. That's why they go back 2 years. But then when it comes to the third and fourth installment, which will be on September 15th and December 15th, they will have last year's information because that return was filed on June 15th, 2024. So what they're going to do is they're going to firm everything up to last year's number. And so they take last year's net tax owing minus what was paid in the first and second installment, and then that amount remaining will just be paid over the last two installments. So the CRA method and the preceding year method will result in the same total amount of installments because they are using last year's number to firm everything up to. But the individual installment amounts will be different. So that's why the CRA has sort of this unusual method, because when it comes to the first two installments, they don't yet have last year's information, so they go back 2 years. But when it comes to the third and fourth installment, they will have last year's information, so they'll just firm everything up to last year's net tax owing. Any questions about the calculations? Now, once again, a taxpayer can use any of these three methods. Now, obviously, if you don't want to take any chances, you would pick the CRA method. But if we just sort of look at this, just sort of rationally, which would be the best method that you would recommend to this taxpayer? Let's assume that the estimates were accurate. So let's assume that this estimate they made for the current year is 100% accurate, is not going to be under. Which method would you tell this taxpayer to use when they were making their quarterly installments for the year? Let's sort of think about this. Think about time value of money. We know that the current year, they're going to end up paying the most. So let's rule out the current year. With the preceding year and the CRA method, the total amount paid over the 4 installments will be $3,190. But we're looking at time value of money. The best method would be the CRA method, because the first 2 installments, they pay 0. So they don't have to make any payments until September the 15th. Overall, they're still going to pay $3,190, the same as the preceding year method. But because of time value of money, the CRA method would be the best. And once again, if we think about when those installments are due, March 15th and June 15th, using the CRA method, they would pay 0. And then on September 15th and December 15th, they would make a payment of $1,595 each. Any questions about case A?
What if this was a case where the 2022 amount payable was actually more than the last year's payable, but
Yeah,
it makes
so-
sense to do the proceeding?
Yeah, so actually we're going to take a look at that. That's a great question, Sam. So we're actually going to get a case 3. So let's have a look at case 3, and that will be exactly what Sam is asking. So the top numbers, the amounts withheld, are exactly the same, but now we're going to look at case 3. So let's look at case 3 and calculate the net tax owing for 2024. So for 2024, we take 13,767 minus the tax withheld, 10,476. And so we get 3,000, sorry, hold on. Did I do that right? Yeah, 13,676 minus 10,476. We get 3,200 for 2024, case 3. So let's put that down here. So net tax owing for 2024, 3,200. Do the same for 2023. For 2023, we have 12,842 minus 9,672. That's going to be 3,170. And then for 2022, 13,146 minus 8,946, we have 4,200. So I think this is exactly what you're asking, right, Sam, is where the 2022 year is a lot higher. Is that what you were asking?
Yeah, exactly.
Okay, so let's take a look at this. Okay, so those are the net tax owing. Is the current year net tax owing greater than 3,000 and either of the previous 2 years greater than 3,000? Yes. So we know that quarterly installments will be required. Now we're going to sort of see which is the best method to use. Now, if I'm just looking at the net tax owing, what I can tell you automatically is that the preceding year is the lowest amount, 3,170. So automatically I know that the preceding year method will be the best. It will even be better than the CRA method, even though the CRA method will end up having the same total, 3,170. The preceding year will be the best, but let me just sort of go through the calculations and show you why. The current year method is just an estimate. So we're just going to use 3,200 divided by 4. And so that would be 800 per installment. The preceding year, 3,170 divided by 4. And so that's going to be 792.50 per installment. So once again, the preceding year automatically is even better than the current year because we pay less. And once again, that's based on an actual number. So we're confident that that 3,170 is fine because it's an actual number, whereas the current year is still an estimate. Let's talk about the CRA method. So with the CRA method now, the first and second installment, we're going to go back 2 years. So we're going to go back to 2022, which is 4,200 divided by 4. And so that's going to give us 1,050 for the first and second installment. Then when it gets to the third and fourth installment, we're going to start with last year's number, which is 3,170, because CRA would have had that information by now. We minus what was paid in the first 2 installments. And then how many installments are remaining? There's 2 more. And so that would be the amount of the last 2 installments. 535 for third and fourth installment. Now, once again, the total that you pay using the CRA method will be 3,170. It's going to be the same as the preceding year because it all firms everything up to last year's number. But the reason that the preceding year is better is because with the CRA method, you end up paying more for the first and second installment. And because of time value of money, it's better to use the preceding year method. So for this one here, the best method for this taxpayer would be the preceding year method. Any questions about case 3? Now, remember we talked about those self-study problems? So this question is assignment problem 2-3. Assignment problems you do not have solutions for, and I'm not allowed to give you the solutions for the assignment problems because other instructors may use the assignment problems for marks. But for every assignment problem, there are comparable self-study problems. So the one that we did before the break for the net income calculations, assignment problem 1-12, if you go to self-study problems for chapter 1, there should be similar calculations and questions where you have to calculate the net income. For chapter 2, there will be similar questions in the self-study problems where you have to calculate installments for individuals. So that's how we determine installments for individuals. Now we're going to just sort of talk a little bit about corporate tax. And so if you end up taking BFIN 451, you will dive into corporate tax in a lot more detail. But in chapter 2, they just talk a little bit about the filing requirements for corporations and their installment requirements. So corporations have a fiscal year end. That's the FYE. Now the fiscal year end can be any date. It can be December 31st. It can be June 30th. It can be January 2nd. It can be any date. And basically it can be sort of any 12-month period. But let's assume that we have this corporation, ABC Corp, and their fiscal year end is December 31st. For the 2024 tax year, their corporate income tax return, which is known as a T2 return, individuals file T1, the corporate income tax is due 6 months from the fiscal year end. So if their fiscal year end is December 31st, 2024, we add 6 months. The T2 return will be due June 30th, 2025. But similar to individuals, if they owe any taxes for the 2024 year, that final payment of tax is due 2 months after the fiscal year end, which will be February 28, 2025. So once again, for corporations, if they are able to gather all their tax information and file it within 2 months of the fiscal year end, they don't have to estimate what their final payment of tax is. But if they don't, then they should make a payment by February the 28th, 2 months after, so that they don't get charged interest and penalty if they end up owing more taxes. Now, corporations have to make monthly installments. So let's take a look at this example here. We're looking at 2024. ABC Corporation has a December 31st year end. And let's say during 2024, they make monthly installments totaling $50,000. So just like those individuals that we just talked about, corporations don't have any tax withheld at source. They're not like an employee. So corporations need to make installments. And we'll talk about the rules in a few minutes. So let's say that ABC Corporation makes the monthly installments at the end of every month like they have to, and the total that they make for 2024 is $50,000. When we get to 2 months after the end of the fiscal year, we have to estimate their total tax liability. So let's say they estimate that they're going to owe $55,000. Their installments total $50,000. So they pay that additional $5,000 by February 28th, when that final payment is due. And let's say that when they do file their tax return 6 months later on June 30th, they realize, oh, we actually owe $57,000, not $55,000. So they've only paid $55,000, right? They paid $50,000 by installments, and then they paid an additional $5,000 by February 28th. They end up owing $57,000 in total, so they pay the remaining $2,000 on June 30th. The CRA is going to charge them interest and penalties from February 28th onward on the $2,000 that they were short on February the 28th. So it's always important that if you don't know your complete tax liability for a particular year and you've got to make a payment by a certain date, we always tell clients to overestimate and make a larger payment So that way they can avoid any interest and penalties. If they end up overpaying, they'll just get it back as a refund when they file their tax return. So what's the rule for corporations to make installments? Corporations must make monthly installments if their taxes payable are greater than 3,000 in the current year or greater than 3,000 last year. So this is an or statement. Unlike individuals, individuals have an and statement. What this or statement says is that as long as one of them is true, corporations need to make monthly installments. Now, there is an exception for what we call small CCPCs. We'll talk about that either later today or next week. But generally speaking, corporations need to make monthly installments because nobody is withholding taxes and sending that into the government for them. So what we're going to do is look at assignment problem 2-2. We have this public company, Marcon Limited. They have a June 30th year end. And we have their income tax payable for the current year. Remember, the current year is just an estimate, and the last 2 years. Now we know that the current year estimate is greater than 3,000. And remember, this was an or statement, right? So even regardless of what was owing last year, doesn't matter because the current year is greater than 3,000. Remember, it was an or statement. So we know that they're required to make monthly installments for 2024. So let's go back to this here. So the taxes payable for the current year, which is an estimate, that was the 407,900. And for last year, it was the 472,600. So we know it's greater than 3,000 in the current year. And once again, it's an or statement. So it doesn't matter what the prior year was. Because the prior year was also greater than 3,000, it doesn't really matter what the current year is. As long as one of them is greater than 3,000, they must make monthly installments. Now, this is an example where the fiscal year end is not the calendar year end. This company has a June 30th year end. So what that means is we're looking at June 30th, 2024. So when does that start? The year would have started on July 1st, 2023. So this is this company's fiscal year, July 1st to June 30th. So because they have to make monthly installments, those installments are due at the end of every month. So these are the dates for the monthly installments. They're due at the end of every month over the 12-month fiscal year. Now, similar to individuals, there's 3 ways to make this calculation. We can take the current year amount, divide by 12. So the current year estimate of taxes owing, 407,900 divided by 12, that would be 33,992 per monthly installment. We can take the preceding year amount, that would be 472,600 divided by 12, and that would be 39,383 per monthly installment. And then we can look at the CRA method, kind of similar to the individual, but slightly different. Remember, for corporations, they need to make the final payment of tax 2 months after the end of the fiscal year. So with the CRA method, when we look at the first and second installment, we're going to go back 2 years to 2022. So in 2022, the taxes owing was 365,400 divided by 12. And so that would be 30,450 for each of installment number 1 and installment number 2. And then for the remaining installments, we're going to firm everything up for last year, which is 2023. So last year we owed 472,600 minus what was already paid in the first two installments. And then that will be divided by the remaining 10 installments, right? Because the first two were already paid. So the remaining 10 installments will be 41,170 each, I believe. Let me just double check that calculation. Oh, that should be 30,450, my mistake. If I go back to the first and second installment, the actual amount should be 30,450, not 350. And so if I redo the calculation here, minus 30,450. Divide by 10. And I should get 41,170. Let me just double check that calculation. Yeah, 41,170 for the last 10 installments. So that would be for installment number 3 through number 12. So again, it's kind of similar to the individuals, but once again, if we sort of look at just the 3 years of net tax owing, let me put 2022 up here. So for 2022, the taxes payable were 365,400. If we just sort of look at these three totals here, we know that the current year is the lowest. So in this example, the best alternative would be the current year. But the only caution about the current year is that this is just an estimate. So once again, if you underestimate, then the CRA is going to say, well, you know, we're going to charge you penalty and interest based on what you should have paid. If you're looking at between the preceding year and the CRA method, which is better, because the 2022 was lower than 2023, we know that between these two methods, the CRA method is going to be the better of the two. The reason is the first two installments are going to be lower. And so when we look at the cumulative amount paid during the year, the CRA method will cumulatively work out to be less, and it won't firm up to the total until the very last installment. So in these three installments, the best is the current year, but there's always a risk that if you underestimate, that the CRA may charge you penalty and interest. And if you're looking at between the preceding year and the CRA method, the CRA method is better time value of money because 2 years ago they had less taxes owing. So the first two installments will be lower. And even though they end up paying more for the remaining installments, they still sort of be a little bit behind compared to the preceding year. And so time value of money between the preceding year and CRA, the CRA method would be better. Any questions about this problem for corporate installments? So what I want to do then is I want to actually start the other chapter 1 and 2 handouts. So let me just save this one. I think that was it here. Yeah, that was it. So I'm just going to save this one and let me just bring up the other handout for chapter 1 and 2. And we'll start that today, and we'll probably won't get through it all today. And then we can finish it next week, and then we'll start chapter 3 next week as well. So let me just quickly bring it up. So this is the chapter 1 and 2 extra review handout that I posted on eLearn. And one of the things that we're not going to have time to really talk about is this concept of residency. So residents of Canada are subject to tax under Part 1 on their worldwide income. So what that means is that if you are considered a resident of Canada, you're going to be taxed on your worldwide income. So not just the income that you earn in Canada, but basically sort of all your income that you earn around the world. So then what determines whether you're a resident or not in Canada? And so that's sort of where they talk about your ties to Canada. So they say residence is determined based on your residential ties to Canada. And they sort of talk about that in chapter 1 over a few pages. And so they look at things such as, do you have a dwelling? Do you rent a place? Do you own a place in Canada? If you do, then that's considered a residential tie to Canada. Do you have dependents? Do you have a spouse that lives in Canada? If you do, that would be considered a residential tie that you have to Canada. And so they look at all these ties you have to Canada, and that determines whether you're a resident or not in Canada. So what that means is, even if physically you're not in Canada that often, so let's say you're traveling between Canada and maybe another country, but you have all these ties to Canada. You're renting or you own a place in Canada. Your spouse, your dependents are here. You have bank accounts in Canada. Then you might be determined a resident of Canada for tax purposes, and then you're going to be taxed on your worldwide income. Another way that you could be taxed on your worldwide income is if you are a sojourner. A sojourner is an individual that's in Canada for more than half the year, which is 183 days. Now, it does not have to be consecutive. And so this could actually apply to maybe a lot of individuals that are maybe traveling in Canada and maybe working in Canada as well. So because Canada is part of the Commonwealth, it's easy for maybe individuals that are from Britain, from Australia, from New Zealand to work easily in Canada compared to individuals from other countries. And so if let's say there's an individual from Australia, they come to Canada in January, they work in Whistler for the ski season till the end of March, then they go traveling in the US, then they come back to Canada in May, they work in the summertime at one of the resorts. And if the total days that they're physically in Canada and part days count as well is 183 days or more, then they will be taxed on their worldwide income, even though they're not a citizen of Canada. Because they are in Canada for more than half the year, they're required to file their Canadian tax return and include their worldwide income, not just their income from Canada. And so I would encourage you just to read through those parts of the chapter 1, because we're not going to have time to go through all that in detail. Now, for corporations are deemed to be a resident of Canada if they were incorporated in Canada after April 26th, 1965, which is a long time ago. So as long as basically the corporation was incorporated in Canada, they're deemed to be a resident of Canada. And so therefore that corporation needs to file a tax return and once again include their worldwide income. So just some other parts of chapter 1 that we won't have time to cover in detail. One thing that we did talk about on the previous handout was that individuals file a T1 return, and that T1 return is due April 30th of the following year, unless the taxpayer or their spouse is self-employed. If the taxpayer or their spouse is self-employed, both of them have until June 15th to make the filing of their T1 return. The one thing that's also talked about is a deceased taxpayer. So if someone dies, then obviously the executor of the estate will have to file their tax returns. For a deceased taxpayer, the due date is the later of 6 months from the date of death or the regular due date, whichever is later. So in order to sort of illustrate that, I'm going to use this exercise from the textbook. So remember I said that when you read through the textbook, there are these exercises. And these exercises are just short problems that relate to what you just read. And the solutions to the exercises are in the study guide. Remember, when you buy the textbook, you get volume 1, volume 2, and the study guide. The study guide has all the solutions to the exercises and those self-study problems that I posted on eLearn. So we have this deceased taxpayer, Sally. She dies on February the 15th, 2025. Now, because it's February the 15th, she hasn't yet filed her 2024 or 2025 return. Now, the 2025 return will only be from January 1st to February 15th, the date of death. Now, her spouse carries on a business in both years. And so because she is now deceased, her legal representative needs to file both the 2024 and 2025 tax return. And we need to tell them what is the latest that those returns can be filed. So let's talk about the 2024 T1 return first. So the 2024 T1 return will be due the later of 6 months from the date of death, and the date of death was February 15th, 2025. So this is months, not days. So we can just go February, March is 1, April 2, May, June, July, August. So that would be August 15th, 2025. And then the regular due date, because her spouse is self-employed, the regular due date would be June 15th, 2025. So the later would be August 15th. So they have a bit of an extension because it's based on the fact that she died. Things may not be readily available. The legal representative may have to search for some of the documentation. So they're given a little bit of an extension. Now, when it comes to the 2025 T1 return, this would only be to the date of death. And once again, in Chapter 11, they talk a little bit about date of death returns. And so that's something that will be covered later on. In terms of sort of estates and trusts, that's covered in Chapter 19. If you end up taking BFIN 451, you'll sort of cover a little bit about estate tax in that chapter as well. But in terms of just when the 2025 T1 return is due, it's going to be due the later of, once again, 6 months from the date of death. Well, 6 months from the date of death is going to be the same, right? So she died on February the 15th. 6 months later is going to be August 15th. But the regular filing due date for the 2025 return will be June 15th, 2026, because once again, her spouse is self-employed. So the later date will be June 15th, 2026. That would be for the 2025 T1. So I just want to sort of go through that problem with you, just to sort of show you how the dates could change when a taxpayer dies. Any questions about this exercise? The next thing I want to talk a little bit about is installments for corporations. Now, we just did the installments for individuals, so that's sort of this little summary here. But what I want to focus on is corporations. If you remember when we did corporations, I said there was an exception for what was called small CCPCs. So I want to sort of explain to you what that exception is for what we consider small CCPCs. And I want to sort of use this example here. So let's have a quick read through this example together. Lamar Limited has a December 31st year end. Let's assume first that it is not a small CCPC. We're told that the taxes payable for 2022 was 71,500. For 2023 was 93,600. And then for 2024, there's an estimate of 114,700. Now, if this was not a small CCPC, then in order to determine their monthly installments, the current year method, we would just take the 114,700 divide by 12, and that would be 9,558.33 per monthly installment. Another method would be to look at last year's number, so 93,600 divided by 12, and so that would be 5,958.33 per monthly installment. And then just to sort of quickly do the CRA method. The CRA method for the first and second, we go back 2 years. So 71,500 divided by 12. So that would be, oh, sorry, there's a bit of a typo here. This 93,600, this is actually the wrong number. That's 7,800. It's a CRA method that we use the 71,500 divided by 12. And so for the first and second installment, it would be 5,958.33 for first and second installment. And then for the last 10 installments, we go to last year's number minus what was paid for the first two, so minus 5,958.33 twice. And then we divide that by the remaining 10 installments. And so that would be 8,168.33 for each of installment number 3 through to 12. So that's sort of what we did, similar to what we did in the last handout, was we looked at these monthly installments for a corporation, and we calculated it based on these 3 alternatives. So when you sort of look at these 3 alternatives, once again, an easy way to figure out which is going to be the best is, well, the current year is the highest, so we know that the preceding year is going to be lower, which is better. But because 2 years ago, it was even lower, we know that the CRA method is going to be better than the prior method because of time value of money, because they pay less for the first 2 installments, and then cumulatively, they're not going to firm everything up to 93,600 until that very last payment, number 12. And so based on time value of money, the CRA would be the best method to use. So that's sort of what we did, similar to the question we did on the last handout. But in the textbook, they talk about the fact that if a company is what we call a small CCPC, then they can make quarterly installments. So I want to just sort of talk about that. If Lamar was a small CCPC. So let's talk about what does CCPC stand for. CCPC stands for Canadian Controlled Private Corporation. And there's sort of a definition in the textbook that talks about what is a small CCPC. And you can sort of read that definition. It's listed on page 80 and 81 of the textbook. And that sort of tells you what is a small CCPC. So a question in the chat, in a scenario where the current year estimate is higher, would it be best to use that to avoid penalty and interest? So Hayden, if we look at this one here, well, this one here, this current year is higher. If you want to be safe, you can always use the CRA method, because the CRA method is the one that the CRA tells you is the minimum you have to pay. And so if you always want to be safe, just use the CRA method. And in this example, the CRA method just happens to be the best. If, for example, the current year method, let's say the current year was only 20,000. Let's make it 24,000 for ease. So if the current year was 24,000, we would take 24,000 divided by 12, and we would have 2,000 per installment. In that scenario, the current year would be the best. But what you have to be careful with is that if you underestimate and you actually had taxes payable of 30,000, then you should have based your installments on 30,000, not 24. And you would be you would be charged interest and penalties for not basing it on 30, but only 24. So it's sort of a bit of a, I guess a little bit of a risk. If you decide to use the current year method because the current year amount estimate is a lot lower, then you can do that. But if your current year estimate happens to be under what it actually turns out to be, then you can risk paying penalty and interest. So if you are going to use the current year method, what I used to tell clients is always estimate a little bit higher. If you think it's 24,000 for the current year, maybe use 36,000 just to be safe. You have quite a bit of a buffer. And so that way you can avoid any interest and penalty if your estimate of 24 is too low. But if you want to just play it safe, then always use the CRA method. So it's always a little bit of a gamble if you use the current year because it's just an estimate. Does that answer your question, Hayden? Perfect, thank you. So I'm going to just wrap up by looking at this small CCPC. So if you are a small CCPC, and once again, the definition is talked about on page 8081, then you can pay quarterly installments rather than monthly. And if you end up taking the corporate tax course, BFIN 451, what you'll see is that the government gives private corporations some tax breaks, some tax benefits. And this is sort of one of them. What they're saying is that if you're a private corporation, you're a family-run corporation, you're not a big public corporation, you're not this money-hungry public corporation, then, rather than make you pay quarterly installments, or rather than make you pay monthly installments, we're going to make you pay quarterly installments. So how would we calculate this? Well, we can use the current year estimate of, once again, in this question, it was 114,700. Quarterly would mean 4. And so it would be 28,675 per quarterly installment. We can use the preceding year amount, which would be 93,600 divided by 4. And so that would be 23,400 per quarterly installment. And this is how the CRA would do theirs. For the first installment, they would go back 2 years, 7,500 divided by 4. And so for the first installment, it would be 17,875. Now, the first installment, if this is December 31st year-end company, the first installment would be due March 31st, end of the first quarter. Now, the remaining 3, the second to fourth installment, this is where we go back to last year. By this time, last year's taxes would be available, 93,600 minus what was paid in the first installment. And how many installments are remaining? 3. So for the last 3 installments, it would be 25,241.67. And those would be due end of the second quarter, June 30th. Oops. End of the third quarter, September 30th. End of the fourth quarter, December 31st. So I just wanted to sort of show you that because the textbook does go through that in the chapter 2 about small CCPCs, being able to make quarterly installments. Any questions on the small CCPC calculation for quarterly installments? Just sort of looking at the handout here, we only have one topic left. And so because we're only at 8:26, I'm just going to finish this off. That way, when we meet next week, we'll sort of just start off fresh with chapter 3. Chapter 3 and 4 are a lot longer. So we will need more time for chapters 3 and 4. So I want to just talk a little bit about assessments. So after you file your tax return, the CRA will issue what's called a notice of assessment. If after the notice of assessment is issued, let's say they modify that tax return, then they will issue another notice called the notice of reassessment. So if, let's say, you file your tax return, the CRA issues a notice of assessment. Let's say later on, they get additional information saying, okay, this taxpayer forgot to include some rental income. So they do a reassessment, they reassess the tax return, then they're going to issue another notice, but that subsequent notice is called a notice of reassessment. Now, in terms of how far back the CRA can go, the normal reassessment period ends 3 days after the mailing of the notice of assessment for individuals. So you file your 2024 tax return, let's say on April 30th. A few weeks later in May 2025, you get the notice of assessment. 3 years from that date will be when the normal reassessment period ends. So normally after 3 years, if you don't get contacted by the CRA, they're not going to contact you for an audit. The only exception is if there's any sort of fraud or criminal activity. If there's sort of any fraud or criminal activity, the CRA can reassess as far back as possible. But normally 3 years. For corporations, usually 4 years. So that's sort of the normal reassessment period. You might hear some individuals say, keep your tax records for 7 years. Just a little bit of a safety net so that after 7 years, if you don't hear from the CRA, you can basically sort of just shred those documents that relate to that year. Just as a bit of a safety net, they usually say 7 years. But once again, if it's criminal or fraudulent behavior, the CRA can go back as many years as possible. Now, what about if you disagree? So let's say you want to dispute what the CRA has assessed you for. Well, the CRA always says, go the informal route. Basically, contact the CRA. So this is usually initiated by yourself, the taxpayer, or your accountant if they're authorized to act on your behalf. And usually that would just be a telephone call to the CRA or a letter to the CRA, just saying, we disagree with this assessment that you sent us, and this is the reason why. That is the informal route. Now, sometimes the informal route does not work, and you have to file a formal notice of objection. There are time limits for when you have to file the notice of objection if you disagree with what the CRA says. If it's a corporation, the notice of objection must be filed within 90 days from the date of the notice of assessment or reassessment. That's pretty straightforward. The notice of assessment is dated January the 8th, today. We just add 90 days to that, and that's when the notice of objection has to be filed by the corporation if they want to object to what is on the notice of assessment. Now, for individuals, it's a little bit different. It's the later of 90 days from the date of the assessment notice or 1 year from the filing due date. So I'll just sort of wrap up by looking at this exercise here. And then figuring out when does this individual have to formally file the notice of objection. You don't have to go the informal route. You can go directly to file a notice of objection, but the CRA encourages you to do the informal route first because maybe that might resolve it without having to go through all this additional paperwork. So we have this individual, Jerry, file the 2024 tax return on April 30th, 2025. The notice of assessment was dated May 20th. So usually a few weeks after you file your return, you'll get the notice of assessment. But that's the date of the notice of assessment, May 20th, 2025. Now, a year later, he gets a notice of reassessment. He gets it on May 22nd, 2026, but the notice of reassessment is dated May 15th, 2026, saying that he owes additional tax for the 2024 year. When can he file the notice of objection by? What's the latest date if he wants to object to this notice of reassessment? So once again, if we look at this exercise, the notice of objection must be filed by the later of 90 days from the notice of assessment or reassessment. And so in this example, it's a notice of reassessment. The notice of reassessment, we look at when it was dated. It was dated May 15th, 2026. So it's not the date that he receives it, it's 90 days from when it was dated. So we basically have to add 90 days to this. So if you think about how many days are left in May, May goes to 31 days. So there's an additional 16 days in May. And then June has 30 days. July has 31 days. And so we just sort of add up those days so far. That's going to give us what? 60, 70, 77 days. And so an additional 13 days would get us to the 90 days. So that would be August 13th, 2026. So that would be 90 days from the date of the notice of reassessment. That would be August 13th, 2026. And then the other date that we look at is 1 year from the filing due date. So when was his 2024 T1 return due? There was no indication that he was self-employed, right? So the filing due date would have been April 30th, 2025. We add 1 year, and so that's going to bring us to April 30th, 2026. So between the two, the later would be August 13th, 2026. So if he wanted to formally file this notice of objection, he would have to file that by August 13th, 2026. All he would have to do is just sort of download this form from the CRA website, complete it, and then file it either electronically or mail it in. And that would sort of start the appeals process. What would happen is when the CRA gets this notice of objection, they'll assign the file to what's called an appeals officer. That appeals officer will contact the taxpayer and says, why do you disagree with this notice of reassessment? Get their side of the story. They'll look at what the CRA did and then sort of come up with a conclusion based on the evidence that the appeals officer collects, and then sort of let the taxpayer know what the decision is.